Hello, everyone, and welcome to today's lecture on derivatives. In our previous sessions, we discussed futures and forwards. Today, we're going to talk about another important derivative instrument, options. By the end of this lecture, you should understand what options are, their features, why they are used, and a few examples of how investors and traders apply them. An option is a financial derivative that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price, called the strike price, on or before a specific date, known as the expiration date. The underlying asset could be a stock, an index, a currency, a commodity, or even an ETF. The main purpose of options is to manage risk through hedging, seek profits through speculation, or generate income by writing or selling options. Options have several important features. First, there are two main types of options. A call option gives the right to buy the underlying asset at the strike price. A put option gives the right to sell the underlying asset at the strike price. Second, there is a premium. This is the cost paid by the option buyer to the seller, also known as the writer of the option. Third, while the buyer has a right, the seller has an obligation. If the buyer decides to exercise the option, the seller must deliver or take delivery of the underlying. Fourth, options have expiration. They are not perpetual contracts, they have a limited life. Finally, options provide leverage. With a relatively small investment, an option can give you exposure to a much larger notional value. Let's look at some examples. Imagine an investor who expects stock XYZ, currently trading at $50, to rise over the next 3 months. This investor buys a 3-month call option with a strike price of $55, paying a premium of $2 per share. Each option contract covers 100 shares. If the stock rises to $65, the payoff is $10 per share. After subtracting the $2 premium, the net profit is $8 per share, or $800 total. But if the stock stays below $55, the option expires worthless, and the investor's maximum loss is the premium paid, which is $200. Another example involves a put option. Suppose an investor owns shares of stock ABC at $40 and fears the price may fall. The investor buys a put option with a strike of $38, paying a premium of $1. If the stock falls to $30, the put is worth $8, which helps offset the losses in the stock. This is how options can act as insurance. Why do we use options? First, hedging. Investors use options to protect against adverse price movements. For example, buying put option on a stock they already own. Second, speculation. Traders can use options to bet on expected price movements with limited risk, the risk being the premium paid. Third, income generation. Investors can write covered calls or cash-secured puts to collect option premiums as steady income. Finally, flexibility. Options can be combined into strategies like straddles, spreads, and strangles to reflect more complex views on the market. In summary, options are powerful derivatives that provide the buyer with rights, the seller with obligations, and both parties with tools for hedging, speculation, and income. They are versatile but require careful understanding. This concludes our discussion about Introduction to Options. See you at the next lecture.